In Chapter 11, we're dealing with some of the accounting issues that arise when a firm sells pieces of itself, called shares, to outside investors, called equity shareholders. One thing to keep in mind is that the owner's equity piece of a firm's balance sheet has two distinct components. One part deals with the money that equity holders contribute, called paid in or contributed capital, and the other deals with retained earnings, the profits that the firm has held onto for reinvestment in the company. We're going to spend the first part of this exercise talking about the paid-in capital piece. Before we get started, let's review a little bit of terminology related to the sale of shares to investors. So paid-in capital ends up being the amount of money that stockholders pay in exchange for a piece of the firm. This will end up reflecting the amount we sell the stock for, which is going to be based on the market value of the shares. Common stock ends up being money that is set aside for the protection of creditors. And this came up in the old days because states required that firms assign a par value for each share sold that must remain in the business. And it ended up being pretty small compared to the overall value of the stock issuance. Nowadays, states don't generally require, many states don't require any par value, although firms in these states often do assign what is called a stated value that works the same way for these shares. And then there's paid-in capital in excess of par. And this is going to end up being the difference between what we sell shares for, the paid-in capital piece, and the amount set aside in common stock that's based on par value. Hence, we call it paid-in capital in excess of par. So when Flanders sells 10,000 shares to the public, he's going to end up receiving $100,000 because each has a market value of $10. And so what we're going to do is we're going to take the number of shares, or 10,000, times our selling price of 10. And so Flanders is going to have paid-in capital of $100,000. The par value of these shares is given as $1. So we're going to designate $1 for each of the shares issued, a total of 10,000, for a total common stock amount of $10,000. And then any excess will get called paid-in capital in excess of par, which in this case is $90,000. And so our entry in this case is going to entail a debit to cash for the amount raised, or $100,000. And then our credits are going to be $10,000 to common stock to reflect this money that we're holding back to protect creditors. And then any leftover amount is going to be designated as paid-in capital in excess of par, and again, that was $90,000. Now, people aren't going to give money to Flanders for free. Firms often make periodic payments called dividends to their shareholders to keep them happy. I think of dividends as a way for firms to return some of the invested capital back to their shareholders. Note that firms aren't required, however, to pay dividends to their common shareholders at all. Now, there are going to be 3 dates that we're going to need to be aware of: the declaration, record, and payment dates. The declaration date is the day the board of directors formally authorizes a dividend. And even though firms aren't obligated to pay dividends, once they make a declaration, they are then legally obligated to make that payment of that dividend. So we're going to see that this is going to end up resulting in a liability on that declaration date. Now, in their declaration, firms will specify 2 other dates: the record date, which is the date the company checks to see who owns shares in the firm and is therefore eligible for a dividend, and the payment date, which is the date the firm will actually pay the dividend. So let's go through the entries at each of these dates, assuming that Flanders announces a 25-cent dividend per share. And so what we can do is we're going to take this dividend per share of 25 cents. We're going to end up multiplying that times 10,000, and because that's the number of shares that are out there. And so what's going to end up happening is that Flanders is going to end up paying $2,500 in dividends to his investors. And so, as I mentioned, a dividend declaration involves a legal obligation. So as a result, on the date of the declaration, we're going to end up crediting a liability account, in this case called dividends payable, for the amount of the dividend. In this case, it is $2,500. And the debit is to our temporary account dividends. And that's going to be for another $2,500. Now note that dividends is a temporary account. And so in the closing process, think back to chapter 4, this dividend account will end up being closed out to retained earnings. When this happens, there will be a credit to that temporary dividend account and a debit to retained earnings, showing that we have paid out some of our hoarded or accumulated profits to shareholders. Now on the record date, we actually don't do anything because that's just the date in which we check to see who has shares in the firm. So there's actually no entry necessary on the record date, in this case of May 31st, 2010. And finally, on the payment date, this is when we're going to actually pay the cash to our shareholders. And so we're going to have a credit to cash for the amount of the dividend, $2,500. And then we're going to be able to get rid of the payable, this obligation, because we don't have that obligation anymore. We have paid the dividends, so I'm going to debit dividends payable for the amount of the dividend, $2,500. And that's it.